details with Mr. G.S. Chahal, who is the CFO at Meghmani Organics. Thank you so much, Mr. Chahal, for joining us on ET Now. Given the fact that we have seen the European gas prices up about 135% in the last 4 months, with this high energy, the cost crisis in Europe, do you think that we can assume now that the world is going to diversify away from Europe? Is Europe plus going to be as smooth sailing as China plus one?
Good morning. As you rightly pointed out, actually, two major economies, China and Europe, is going under crisis. So definitely from India perspective, we are in a sweet spot and a lot of traction, and we are seeing the queries from the global customers towards India. So in our case now, we have two verticals, agrochemical and pigment division. So we see a lot of traction, and in case of agrochemical, though crude is in the range now in a couple of months, so it is under 95 now, and prices from the last quarter we have seen 10 to 12% contraction in the prices has already happened, and in the similar way in the finished goods prices, same way it has corrected. So we see in the coming quarter, I think things getting normalized, and definitely from Europe and all that, where this plants has been shut down. So a lot of demand is coming to India. And as a Meghmani, we are well placed to take this opportunity on.
So, Mr. Chahal, let me take that point forward. We have been hearing a lot of headlines and reading a lot of headlines actually with respect to what's happening in Europe. But the question is it actually converting to inquiries and order booking now? What's the sense on the ground? Are you seeing increased traction and conversation with clients?
No, actually, whatever supplies were happening from Europe, so those have been cut off actually. So Europe itself is going under recession, so demand in the Europe itself is reducing. So, but from the other customer perspective, so whatever supplies are there and consumption is there, so that's why in India, overall demand globally, because there is a recession fear is going on, so there is a slightly downward trend as far as demand is concerned.
No, so if you can just break it down for us, as of now, how much of your revenue is coming from the European region and how much of an incremental benefit do you see on the back of this news, and how do you see your overall revenue pie growing?
Yes. In agrochemical, we are majorly present in Asia and Latin America and all other continents of US. In Europe, we have a very insignificant, hardly 5% in agrochemical exposure to Europe. In case of pigment vision, we have 10 to 12% exposure to Europe.
Fair enough, that point is taken, but also wanted to understand from you, how's the company gearing up to make use of that opportunity? I understand that you had a great Capex plan going with the Dahej facility expected to come on board in the third quarter of this year itself. What kind of progress have you made on that, and what are the other Capex plans?
Yes. As far as this agrochemical multi-purpose plant is concerned, so definitely that is coming on stream now in shortly. In the next quarter, we will be commissioning that plant. And for that, we are already in discussion with the major MNC customers where we are going to supply to them. And we will be spending 350 crore, and we hope from fourth quarter onwards, this capacity ramp up is going to start. And it will add significantly to the top line in next year, around 600 crore plus. So that is the way we are going ahead. And once we are commissioning this project of multi-purpose plant, and simultaneously we are going to announce the next Capex also, for which detailing is being done. So in the agro division, we will be announcing another Capex.
Well, given the fact that you're talking quite optimistically about how the demand is actually shaping up, in the sense that how much is coming to India now, your aspiration of hitting a revenue number of 4,500 crores by FY25, is it likely to get advanced now, and are you likely to hit that number sooner than earlier expected?
This number is put together actually for both the divisions, and last year we clocked 2,500. As you know, in pigment division also, with the diversification into titanium dioxide, and that project also is coming on, first phase is coming on stream. And that is more from the domestic perspective, where end use demand is significantly growing in the paint sector. So we are going to capture that opportunity. And once that is commissioned, and next year again, we are thinking from this project itself, with 50 ton of capacity, around 250 to 300 crore of top line will be added. And simultaneously, we have already started work on expanding the capacity from 50 ton to 100 ton, which will be 33,000 ton per annum. And in the third quarter, we will be commissioning. So after that, it's going to be 700 crore plus. So definitely, we are very much bullish on both the segments because the end user are growing. And that's why we are, as you mentioned, 4,500 definitely in the next 3 to 4 years. We see with the growth rate of 20% plus, we should be growing and we should surpass that number.
Okay, given the fact that a lot of the leading European fertilizer companies like Yara, etc., they've recently announced production cutbacks on account of these high gas prices, what does this mean for the agrochemicals business of yours?
Agro, does not have much impact as far as gas price is concerned. It has impact on pigment division. But on the same time, it is balancing it out because crude is coming down. So other raw material price has come down. So it is balancing out.
There are so many moving parts. Help us understand the net impact on margins. How is it likely to play out?
Yeah, as compared to last year, there are two factors which has impacted the margin. One is the raw material price, where it's getting aligned now. And the second is the logistic cost. You see, there is a lot of improvement as far as logistics is concerned. So those prices have softened significantly. So that's why we are seeing, so as far as the EBITDA margin, we say around 2.5% should be contraction in the EBITDA margins overall due to this volatility into the prices.
All right. So just give us an outlook in terms of your overall Capex plans in the long haul and, how are you looking at how much, potential EBITDA increment you can see with titanium dioxide segment contributing to your overall margins, given that it is an EBITDA lucrative product?
EBITDA margin, as this titanium dioxide, we say there is a very EBITDA lucrative product. And we expect 22% plus margin in this product, while in our existing phthalocyanine pigment, margins are at 10 to 12%. So overall, it will improve the EBITDA margin for pigment division, which will go from currently 12% to 15% plus. So this is the range we are seeing in pigment division. Agro division, we are already in the upper range of the industry average, which is 17 to 19%. I think it will continue in that range. And we will always aspire to be at the higher range of the industry average.
And we wish you all the very best. Thanks much for taking time out and